Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everybody. On today's FIN-LYT by EWA podcast, Jamison Smith and I are going to be talking about fees in the wealth management and financial planning industry. So really excited about this episode. I think awareness is everything. As our goal here is, financial literacy. I found a lot of clients could really benefit from using a financial advisor. However, there are a lot of people out there that get taken advantage of from the financial services industry and from specific financial advisors. So there's really good people out there and there's some bad apples. So the purpose of this episode is to educate on the options, what clients can look out for, and just have a general education on making sure they choose the right advisor to guide their family's financial security in the future. So before we get started, Jamison, just give us a quick background because this has been an evolving landscape. I always use an analogy of in traveling world, travel agents decades ago used to be how you did everything. And now that industry has shrunk dramatically. I want to say probably by more than 90%, or a lot of stuff can just be done simply online through credit card points, et cetera. So the fees in financial planning have drastically changed. So give us the landscape of what it looked like, 50 years ago and what it looks like today.
Yeah. First, to hit on what you said at the beginning, super excited to talk about this. I think there's just not very much transparency in the industry in general. So understanding how fees are structured, what you're paying for is really important, and to make sure that you're getting the value for the fee. But
absolutely. Yeah.
Taking a look back, I think it's helpful to understand kind of how this has evolved. So if you think I think mutual funds first came around in the 1920s or 1930s, 100 years ago. And so there were mutual fund brokers, stock brokers, insurance brokers. And if you think about it, you couldn't get on the internet and go on, Fidelity or Robinhood or whatever and place a trade. You had to I had to call you as the stockbroker and say, place this trade for me. And then you got paid a commission for doing that trade. So that's basically how it started. Whether you're buying insurance, buying a stock, buying a mutual fund, you called the broker, they purchased it for you, and they got paid a commission. In the 1970s, the CFP exam was created, and that shifted a little bit more of the industry towards planning, giving advice, not just selling a product. And then what really was the big shift is the internet in the 1990s. I mean, as the internet disrupted a lot of industries, it just made information so much more available. Now we can go on our iPhones and, Google what's a Roth IRA, and you'll have the answer there pretty quickly. But people were able to self-educate, get more available, more advice, and it just basically increased the client expectation of what they want from an advisor, because if they can go get a lot of the info online, it kind of just creates credibility for advisors because you get it fact checked very quickly. So that was a big shift over the industry. And then probably the last 20 to 30 years, there's been a shift towards RIAs, which is what we are. We'll talk about in a second. And that's more so giving holistic advice rather than just investment management. And the other big shift too was ETFs and passive investments became more popular in the early 2000s. And this, you'll hear buzzwords of fee compression, and that's really what started that was ETFs and passive investments. They're a lot cheaper versus buying a mutual fund and paying a 1% fee. So all of that kind of came into play over the last 20 years. There's been a big shift in fees, and I think the big issues now is it's hard to understand all the fees you're paying, especially as a consumer or a client. Unfortunately, it's not always transparent. I was actually meeting with a new client last week, and they had worked with an advisor for probably 40 years. And they said, hey, how are you compensated? And I just gave them a really direct answer on charge and asset management fee, et cetera, et cetera. And they said, we've worked with our advisor for 40 years, and he is never able to directly answer that question. And so that just a light bulb went off. I was like, that's pretty crazy that statistically, majority of the industry doesn't have to act in the client's best interest. So yeah, all of that was a long explanation of a background and kind of where we are in a landscape now of transparency, information available and kind of compression of fees, and more so paying for advice versus just a product.
No question. So if someone, there's the stockbroker days, there's the insurance commission days, and those are still out there, but they're far and few in between. Mm-hmm. Most, just as competition really is good for industries, as it makes the common denominator, it make all ships have to rise, type of analogy. So let's talk about the landscape today, and thanks so much for giving that background. So right now, the industry isn't limited to these four, but these are the four most common that we see. So there are, essentially commission salesmen that can call themselves financial advisors because they pass a test after studying for 2 weeks and don't even need a college degree. So these are very common in big insurance broker dealers. These are very common in a lot of life insurance companies. Would not be common in like wirehouses, because wirehouses, most of the time they're gonna vet you out. They want you to have some experience. They want you to have a personal network that's pretty rich, and so commission salesmen would look like this. Someone is licensed to sell life insurance, and someone is licensed to sell mutual funds through what's called a Series 6 and 63. Now there's one other test you need to pass, but these are pretty simple tests that someone without a college degree could pass within a couple weeks, right? So how the relationships would work with a commission salesman, and I'm gonna give you a good example and a bad example. So a bad example, which I would say unfortunately be the regular if you're working with a commission salesman, is they meet with you. They're the best connectors, so you're gonna probably feel pretty good after meeting with someone with this or that. They're gonna ask you really good questions. And then they're going to come back, and after you to share your life story and life aspirations and 20 different goals, which could involve paying off credit card debt, paying off student loans, they're probably coming back and pushing one or two products very hard. And those products may be like a whole life insurance program saying this is going to fix all your life's problems. And where that industry really gets a black eye is these commission salesmen are really getting in front of usually like the lower middle class. And those type of products are typically never appropriate for the lower middle class. Now, advisors in RIAs or in wirehouses who typically work at the high net worth, those kind of products are appropriate for estate planning, tax efficiency, et cetera. So that's where the industry is kind of has a black eye, and where it was reversed. And I think a lot of financial literacy can help fix these problems. That advisor would also show up and probably sell some type of mutual fund that has a really high upfront commission, what we call an A share. So usually it's like a 5.75% upfront commission, and then an internal cost that, let's just say, is like 1 to 1.5%. So the client, if the client puts $100, $5.75 goes into commission. Every year they're going to pay an expensive cost, and the reason for that is that fund has to pay the manager of the fund. It has to pay a kickback goes back to the advisor that sold it, so they get paid ongoing, usually what's called a 12B1 fee of 25 basis points, 0.25%. And then also there's revenue sharing to the company. So if the advisor's with a big broker dealer, that company's probably getting action of that as well. So everyone's getting paid, the client's really getting hurt. So that's a bad example.
Can I chime in one thing there? That makes sense 100 years ago when you have a skill that I can call you and you can place the trade. Now I could go on Fidelity and just do that myself. So that kind of eliminates
the need for
that.
Yeah, absolutely. And now realistically, someone in that lower middle class probably needs a term life insurance policy. Mm-hmm. If, middle class family with 3 or 4 kids, they probably need a couple $1 million of term life insurance, which would cost, maybe $100 a month. They can get that on the internet pretty quickly.
Yeah.
A lot of times now without even giving a blood draw. Secondly, they could go on, a big reputable custodian like Fidelity, Vanguard, Charles Schwab, and there's many out there, and invest in like an S&P 500, an international fund, and maybe an emerging market fund. I'm just giving examples, or like a total market index to cover mid and small cap with no upfront fees. So that's the bad example. Now, the good example of a commission salesman, because I have met very good people, and that's where both of you and I got our start, is at a big insurance broker dealer. Now it's on the advisor to navigate, the paradoxes with the company and the conflicts of interest, because, my job was to always operate in the best interest of my clients, no matter how hard it was, just to do that and commit to that. And now we're grateful that we've left and legally have formalized that we're legally required to operate in the best interest of our clients. But where this could look good is if you have a good financial advisor that's part of this environment, that is a certified financial planner, or that has a high level of knowledge. They understand what your family needs. And so, they sell the term life insurance policy for you. The price isn't going to change whether you're getting it online or getting it through them. Now that advisor gets a commission, and so they get compensated for their time. You probably need some other products like disability insurance. And then from an investment portfolio, they understand there are structures of mutual funds or ETFs that they can put you in that you avoid that sales charge. And you just, the internal expenses are there, but you get the account high enough that then you can transition to what's called a wrap program. And wrap programs aren't appropriate for everyone, but I would advise, if you are asking your advisor to be a quarterback, to oversee your financial planning, not just one time with a product sale replacement, but your life as it evolves will require many meetings, many questions, many calibrations. Then you want to be on the same side of the table. So you don't want, to give your advisor this big front commission, then run away. You want them to be compensated slowly and really grow with you, and for it to be fair. So there are good examples of a commission salesman. And I would say if you find a really good one, refer them to all of your friends. If you're, if you're a Henry, so high income earner, not rich yet, for that analogy. Or if you're, lower middle class, if you find a good one that has your best interest, you should be referring, because generally good advisors aren't available for people that don't have $500,000 or $1 million or a couple $1 million. So if you find a good one, let's just say statistically, let's just imagine there's 10% of them out there, you should be referring all your friends to that person, because that kind of education, that kind of service that commission salesman is going to provide is going to be unreachable to most, which is awesome. So I'm going to go on to the second one in a second. Do you have anything to add to the purely commission salesman?
Yeah, I think there's good and bad of all of these. Main thing is just if you're strictly, I don't know, my opinion of the industry, if you're strictly going to sell insurance and get paid on insurance, stay in your lane and sell insurance and get paid insurance, and don't try to give advice on stuff you're not qualified to give. So that would be the big, caveat is, yeah, there are very good commissionable people. Just make sure they're knowledgeable and they fit your specific situation.
For sure. And there are people that sell life insurance that are some of the best financial planners on the planet that exist out there. Because I know some of them, friends with some of them, and they also do good financial planning. So this isn't a one size fits all. I think with any kind of industry, there's going to be good apples and bad apples. So that brings us to the next one. And this is a hybrid, and this is the environment, whether I liked it or not. This is the environment. The commission salesman in our last example is someone that just has license to do the commissions. So what we were at our last firm was a hybrid. We were fiduciaries where we could offer wrap accounts. So there's no commissions, no fees to get in, no fees to make trades, no fees to get out. It was just a flat fee. And so if you looked at my book of business prior to establishing EWA as an REA, 90% plus of the business was that. Even though I was a hybrid, I could do commissions or that, I just chose not to do commissions. And I got flack for that, because that's how, typically a big insurance company gets paid from their young advisors, is taking what's called a grid rate and taking the majority of the revenue. When those commissions come in, they pay you some of it, maybe half of it, and they keep half of it. So I did get a lot of flack because there's just not as much money up front for them if you're a fiduciary with the type of clientele I was a client, which were young people, at first saving for high amounts for the future. So we took we're not going to get paid now, we're going to grow with these people approach. And that really worked out for the relationship between, us and our clients. It did create a lot of friction with our prior company though. So when you have a hybrid option, which I would say is really the majority of advisors that are out there, wirehouses typically have a hybrid option. Insurance broker dealers typically have a higher, and these companies have the most amount of money. So they recruit thousands of new people. Most insurance broker dealers, they have between 2,000 to 10,000 advisors in their field force, and that's per company. So that's incredible. Just the mere power. That's why it's really hard to change, and the industry hasn't just what we think is obvious. Everyone should be a fiduciary. There's so much money behind keeping the industry where it's profitable to companies. It's a slowly evolving change, but the more transparent, the more literacy, the more information that gets out there, it's forcing slow change, which I think is the best thing for the industry. So with that being said, a hybrid advisor can do both. They should disclose that they can do both. and make it clearly what's in your best interest. We disclose that we could do both, but again, 90% plus of our clients were in that wrap program where we're operating as a fiduciary. And then one small thing about, there's two different, we're financial planners. There's different regulators. So what we're talking about right now is from an investment side. If you're at a broker dealer, you're regulated by FINRA. If you're an RIA, you're registered by the SEC, Securities and Exchange Commission. But there's a whole separate aspect of this. If you're just selling fixed insurance products, that's a totally separate. You're governed by, the state, the insurance commissioner of the state in which you're selling products. And if you get licensed in every state, you're governed by each state. So where things get a little bit muddy is if you're selling insurance products that also have investments with them, then they fall into multiple categories. So that's where a hybrid can come into play. And that's why some advisors have trouble leaving those hybrid environments, as they have maybe half and half, like half their clients in the commissionable products from 30 years ago and half their clients in the fiduciary, the wrap accounts, or the advisory accounts. And so sometimes it's hard to unravel the messes of what the industry was 30, 40 years ago. So anything to add to that before I go to the third option?
No.
Okay. So the third option is like purely, think about an attorney that you pay hourly. There are financial planners like this. So we would refer to this as like a fee only person that charges a flat, like not a percentage, but like a flat $100 a month, or sometimes $1,000 a month, or maybe it's $10,000 a month if the person's doing a ton for you, or sometimes it's just a flat fee to do a financial plan for you. So these can be really good in certain situations. Like if you're a do-it-yourselfer who, you have the basics down, you have your insurances covered, you love investments, you love managing, and you just really enjoy spending your time, but not necessarily your time is worth spending the time, but you just enjoy doing the plan yourself. And things get really complex for a certain need, like you need to set up like an irrevocable trust. It may make sense to hire a hourly fee only planner to engage that person maybe for 20 hours and pay 5 or 10 grand just to cover that one thing. So that's where I would say that's appropriate. Where we see and so fee only planners, I want to say, do have a huge benefit to certain clientele. Where I think if someone is just starting a financial plan, they hold a fee only planner, here's what's going to happen. Let's say, I'm the fee only planner and, you're coming to me for financial advice. First of all, there is a conflict of interest, because naturally the more hours I, as an attorney or as a fee only financial advisor, the more hours I get, the better for me, right? So you're going to wonder, if you come to me, you're going to kind of like, I only want you to work on this and this and this. And you don't know what you don't know, right? So you may need this financial plan, a lot of things, but then if you're worried about the bill you're going to get, that can really stop the momentum of a good financial plan. And then secondly, I'm going to come to you with this huge recommendation list. Here's what you need to do with all this. That's great, but most people, with the majority of the population, we found the busy people, physicians, executives, etc., they don't have the time to implement and monitor that. So there's been so many times where clients have engaged a fee only planner, have this big book, let's say from 2 years ago that they were given. They said, this was great, this was amazing. I said, awesome. How much of it's implemented? And they give me a blank stare, and none of it's been implemented. They had this great conversation, all these great recommendations, and then nothing was implemented. So I would strongly advocate that the biggest value a financial advisor can ever provide is not just giving the advice, but making sure the advice that the client agrees upon. Because a lot of times in financial planning, there's different options and you can get to the same place. You could buy term life, invest the difference. You could buy whole life. You could do a revocable, irrevocable trust. You could fund your kids' college through taxable accounts or flexibility or 520. You can get there multiple ways. Actually educating and then taking the next step and following through and implementing it is the greatest value proposition an advisor can get. And I would say the second greatest then is doing it for the client, like taking the time off the plate. And if you're a fee only advisor, that's going to be really uncomfortable. My attorney will love to death, amazing, but you're always wondering how many hours is this thing going to take that I just asked the attorney for. So that's where the fee only hourly purse option number 3, can be amazing. I think for the majority, we've seen it just not work we've seen it work from like advice. We have not seen the implementation work effectively with that. And there's many examples where it has, just in what we've seen, which is obviously biased because clients are coming to us after that experience. A lot of the times, the busier you are as a professional, the less appropriate this is. If you have much time and you're interested in doing it, then this could be really appropriate. So that's the third option. Any additional thoughts on that before we go to the fourth option, which is an RIA, which is what we are today?
Yeah, I would say that just there's conflicts in every model. Like, just
Absolutely.
Candidly, the big one for there is they want to, would want to take more time and then the implementation. And if we were to think about if, your advisor's doing very detailed planning, you own a business or, even for a physician, like a lot of the work that we do, if we were to bill hourly, especially with like how much time our team, not even the advisor in the meeting, just like the team on the back end that's doing a lot of the implementation, probably would be astronomically more than the assets under management fee.
No question.
Situation specific, but I think that's a good segue then into why, the RIA model, fee only, fee for planning, assets under management. But
absolutely. So let's talk about the RIA. Now, this is what we are. So we're biased. So we're a fee only RIA, which means we don't take commissions. We're legally not allowed to take commissions. We actually dropped our licenses that allow us to take commissions when we left our prior broker dealer. So further than that, we also sponsor a wrap program. So if a custodian that we work with, like Fidelity and Charles Schwab, tries to charge, when they do charge like stock commissions or, mutual fund we cover all of those for our clients. So when we say a client pays us a flat fee, let's just say 1%, like that's it, right? The commissions, the in, commissions out, that's it. Well, I shouldn't say that's it. They also pay the soft cost, which they would in any model of any fund, whether they're doing it themselves, whether they're working with the commission, which is the soft cost are what is the cost of the ETF itself? Could be 10 basis points, so another 0.1%. Could be a mutual fund that we have an institutional share class for. That could be, 30 basis points, just an example. So, but as an RIA, so let's talk about the good is we're legally required to hold our clients' best interests. The bad is that, paying 1% to manage a portfolio just to manage the investments, I would say is not worth it. The value proposition is not worth it. So you have to find an RIA that does, a fee only where the conflicts are low, but provides a value proposition that goes so much more above just the investment management. So investment management is just table stakes, but this team would be involved with every decision that you have, available around the clock without, forcing you to pay hourly for any advice that you have, any big life milestones. So I just have some examples I listed out. So the other thing too is not every RIA is run the same, because a lot of people we've seen have messy practices where basically the rich clients are subsidizing the less, the smaller accounts, where the firm hasn't done a properly. Like imagine like you were going to get a car and the car was $50,000, and then I went to get the same car and they offered it to me brand new for $25,000. Like you'd be pretty upset, right? Mm-hmm. I mean, that's not fair. Well, unfortunately, in the investment management standpoint, that happens. We see that happen all the time. A $10 million account may be in the same level of service, paying $50,000 a year to get this amazing plan, but then the $1 million account who's really needy could be getting the same amount of service, same amount of time, etc. So I would advise, you should really be asking your advisor, do you have an account minimum? That's a good thing, because it means when you become a client, you'll be prioritized and your money, your fees won't be subsidizing an account much smaller than yours. Do you have an account minimum? Do you work in a niche? Like who do you work with? So we work with executives, physicians, retirees, business owners. So we have expertise on our team to address all of those. And that means we're able to scale our time. We're able to get answers done quickly. So we're not, researching 10 hours for one client on one topic. We see the questions, 90% of the questions we get, we've seen before, and we've created resources and videos to scale our time to address those things. If I was a fee-only advisor as a one-man shop, I would have to individually go look at everyone. But now, when a new client, we're very efficient. So that's why we're able to do everything I'm able to list out. So the first thing that I think a financial advisor, regardless of the fee model that you have should do is income tax planning. So claiming deductions, credits, making sure you're getting, in the right accounts, Roths, 529s, tax deferral, tax bracket arbitrage. So, just if you're retired, making sure you're taking the right amount from your Social Security, your pension, your IRA to climb those, up to the 24% bracket, and then avoiding going into the higher Medicare brackets, the higher tax brackets by coming out with Roth IRAs, having tax loss harvesting done. So those are all, again, table stakes, but take a lot of time. So for an hourly advisor to do all of that, it just, you'd pay probably 5 to 10 times what you'd pay a percentage person that has a team and the technology invested to automate a lot of these processes. Investment planning benefits, you should have an advisor that's picking low cost investments, asset allocating for you, maximizing returns, lowering risk, investment selection, rebalancing, diversification, making sure your behavior is on track, tax loss harvesting through direct indexing. This person would be doing your estate tax planning. So making sure if you pass with more than a certain amount of money, you don't pay 40% of it to the government. State estate tax savings, making sure probate's addressed, then retirement, maximizing Social Security, maximizing Medicare, managing a sequence of return risk. And then actually like the delegation. So just making sure your time's being respected. And then I would say less than 10% of clients. So we see a lot of people have done an amazing job accumulating assets, and a lot of people have done a very poor job. Where we find the sweet spot of financial planning is people that live presently today their best lives while also securing the future, and then also give themselves permission to spend along the way and permission to spend their time along the way, not think that they're, essentially just like have to be married to their work all the time because they're so afraid of reaching their goals. Because a lot of financial advisors use scarcity tactics and say you have to work, earn. Reality is like a good financial advisor should be saying, live your best life today, also secure the future, and having tough conversations and managing the tension that needs to be in place to make sure, because you only get one life and you can never get it back. So a good financial plan is not over accumulating assets, and a good financial plan is not under accumulating assets. A good financial planning is getting that sweet spot done. And that, in my opinion, is absolutely priceless. And less than 10% of the population has a financial plan that addresses that. A lot of people are over accumulating assets and are miserable at their jobs. A good financial plan would get them happy today, balance today, balance for the future. And that's where a financial advisor, regardless of what structure you choose, how you should choose a good advisor to guide your family's future. Okay, so that's an RIA. There's lots of discussions we could have about that, Jameson, but what else do you have about the RIA? Because I know, we're biased. This is who we are. What else do you have to add about the benefits or potential downfalls?
I'd say 2 things to add. One, exactly rewind what you said at the beginning. Like, if you're paying a fee for investment management and that's it, they're giving you no advice, and they're charging you what somebody would charge you to give you advice, like that's a horrible value proposition. It's so, yeah, if you're high net worth, yes, you should have, like, I 100% am convicted somebody should manage your money for you, because there's a lot of mistakes that could be made, but it is so easy to go passively invest in ETFs, or now with like robo advising, like you could get probably you'll get 90 to 95% of the way there on your own. And so it's like, make sure that the fee is well worth the advice, the decision affirmation, saving your time.
The financial plan.
Yeah. And then the second thing that you said, I think the conflict that arises that I've seen a lot is the over accumulation. If you're charging an assets under management fee, well, that advisor wants you to have as much money as possible under their management because they're collecting more fees. And so that's, why the name of our firm is Equilibrium Wealth Advisors, to create that equilibrium so that exactly what you said, it's a total failure if someone over accumulates and they're not spending anything. So that's really the big conflict that can arise with assets under management. But if you have a good planner, a good advisor, that would never come into play. And
another conflict, I'm glad you brought that up. So other conflicts would basically be like if your advisor is telling you to over accumulate and not, buy the vacation house that's really important to you to travel, or if your advisor is saying you can't afford to spend that, in retirement, and all your money is just sitting there, something's wrong. You should be actively taking the money out, unless like you're literally just want to pass everything to your kids or a charity or something. Then, how well is your money matching your goals? How well is your money matching supporting your life by design? So a fee only planner, if you're evaluating like a real estate deal where no financial advisor is going to most financial advisors wouldn't take commission or get paid for a real estate deal, that's a good setup. Now, if you're going to an RIA for a real estate deal, that firm better have your best interest at heart, because if you do that real estate deal, let's say you put $1 million into this multi-unit, that's $1 million they could be investing, charging that fee that they're not getting, and that's not that. So that's an inherent conflict of an RIA, is to generally favor money that can be managed and to dismiss anything that couldn't be managed. Mm-hmm. So that's just a natural bias that could be present in a firm like ours, where we're telling you, invest everything in the stock market, never consider real estate, never consider private equity, never consider Bitcoin. Because a lot of those things we do not like, not because of the reason I just said, because of other issues, but I just wanted to point out those inherent conflicts, right?
Yeah.
So where a really good relationship can work is where, you as the client is paying as little as possible. If an RIA is doing all those things for you and charging 1% on $1 million, so you're paying them $10,000 a year, and they're doing everything I listed out there, versus you going to a fee-only person and them doing that all without, because the fee-only person probably is a one-man shop, maybe not. They're not going to have the technology to scale all this. So the time it's going to take to do all of that stuff is probably, I would estimate, to be $30,000 or $40,000 a year. So you'd end up paying 3 or 4 times. So where I would say, if you have a high income, low time, need to develop a whole financial plan, that's where you really, an RIA would make sense. If you're a totally a do-it-yourselfer and you have specific, very sniper shot, specific things you want to address, then a fee-only person could be great, where you don't want to hand the money over to an RIA. I would say we are not a good fit whatsoever. And then in any of these, you just need to make sure that you have someone that's willing to quarterback and give you unconflicted, unbiased advice that's in your best interest, which can exist in all of these scenarios.
And save your time is the big thing too.
Absolutely.
You don't have to implement it yourself.
Absolutely. So now that we've talked about this, there are some costs. Let's talk about that. So there's costs, and Jameson, you provide a good outline here. So there's basically 3 types of fees, right? So there's commissions up front, there's expense ratios of any funds that are invested in, and then there's the advisor fee. So give us a quick breakdown of the 3. And then obviously address where these would never be applicable in some and they would be applicable in others.
Yeah, so commissions, we've kind of hammered this. This is just loaded mutual funds, commissions on a stock trade. And we're talking strictly investments here. Insurance is a different landscape. But basically, an advisor, you're paying an advisor to place that trade with you. As we already talked about, technology's made this almost go away when you can just go online, and especially the accounts or the companies like Robinhood have kind of gamified trading, which is a whole nother conversation I don't agree with, but it just made it easy to do. You don't need to pay someone to place that trade a lot of times. But yeah, these are just accepting a commission. Last firm we were at, an individual stock was a $15 trade fee. So just little things.
And that the client was forced to pay.
Yeah.
We wanted to pay that for them, and they wouldn't even let us.
Yeah. So here the conflict could be trade, if you're only collecting the commission, and let's say I'm the client, you're the advisor, I'm coming in for an annual review meeting, and there's no ongoing assets under management, hourly planning fee at all. The only way you're going to get compensated for your time is by placing some sort of trade that's going to generate a commission to you. So that's the main conflict. I would say that's not best for ongoing advice. But
so really quick, who's a big advocate that you can think of, a personality out there that's a huge advocate for paying someone commissions? Can you think of it?
No.
Dave Ramsey.
Oh, is he really?
He still recommends, at least I check. I mean, I haven't listened to him in years, but I believe, because there was
I didn't know that.
A shares, and then he has this whole network of find a Dave Ramsey or whatever they're called, advisor, and then they get kickbacks and all that. And then basically the idea is that all those clients are still Dave Ramsey followers, and then listen to his financial literacy and everything like that. So I would say 90% of his advice is good, but a couple things where his advice is really bad is his return assumptions of 12%.
And he's big in mutual. I don't think he likes ETFs. I think
he's big in mutual funds. That's completely flawed. I mean, if you just look statistically, we just did a podcast on international investing, where over like 30-year periods, less than 5% of, in certain like large cap categories, less than 5% of managers ever outperform the index. So just use ETFs. If you're investing internationally, the mutual funds can be appropriate for the right mutual funds. It's only like a third of those outperform. But just in general, so the commissions is the first type. And then the second type is expense ratio. So this still blows my mind. So commissions in general, other than like because Dave Ramsey is like a huge following, like almost like a cult-like following. And not saying that some of that's bad if you're following, those bad assumptions and ruining your financial plan, but like in general, he does give great advice. What blows my mind is like the expense ratio is still so high. So what's the average expense ratio, even if you're like working in a wrap program or commissions for funds. So if you have a portfolio with a basket of each ETFs, mutual funds, Michael Kitches did a really detailed study on what the average expense ratio is. What is that?
Yeah, so this chart right here, it depends on holistically, the average is 65 basis points, so 0.65%. Smaller accounts are higher, like up to $1 million, the average is 1%.
Meaning you have an advisor one and one to like managers with kickbacks and stuff like that.
So let's just explain that. We call that like soft costs.
Yeah.
It's internal. A lot of times they're not even disclosed. Like you have no idea you're paying them. Like if you go online and buy a Vanguard ETF, you may pay 5 or 10 basis points, super cheap. However, like mutual funds are much more expensive because you're paying that manager. Where a lot of this comes into play is if, let's just say I have a company, I'm giving investment advice, and I also sell mutual funds. So I could then you have a mutual fund company. I could agree, I'm going to sell your mutual funds to my clients, and I'm going to charge 1%, and you're going to get, 25 basis points. Basically, there's markups and incentives to use other companies' mutual funds. So that's where a lot of the big conflict comes in here and why these are so expensive, because you're not just going on to that Vanguard ETF and buying it. There's multiple players involved that are getting paid on this. So in general, it's important just to understand what that cost is. And again, ETFs and passive investments have decreased this dramatically over the last 20 years. But just high level overview, many times not disclosed, and could be another 1% that you don't even know you're paying.
Absolutely. So where that would come into play, a commission salesman, option one, we talked about being in the podcast, you're probably going to be closer to 1% because those upfront charges typically have high ongoing charges as well. If the hybrid is working out of their fiduciary hat, not their commission hat, then most likely the portfolio is probably going to have between 30 to 60 basis points of soft cost. And if you're working the fee-only person, that person's going to direct you on where to put your investments. They're not going to get paid on your investments, generally speaking. So that person hopefully will be directing you to the right investments, and you could pay 20 to 30 basis points if they're directing you to mostly the ETFs, maybe some active stuff in emerging markets international. And then REA, they have the fiduciary duty to pick the lowest cost, best investments for you. So in general, you should be on the lower end with no conflicts, meaning the REAs should not be receiving any revenue kickbacks. And so we're legally set up like that. Like we can't put a client in a fund where we're getting kickback, because all that is, it's the same fund with a different ticker that has a higher expense ratio that gives a kickback to the person selling it. And so we're conflict free in that regard. So every share class that we sell is, what's the cheapest iShare, institutional share that's out there? What's the cheapest that we have available through a big custodian like Fidelity and Schwab? And we've negotiated that we have the availability to do that. So no conflict free, meaning we don't participate in any of the revenue from the soft costs. Those only go to the ETFs, mutual funds, et cetera. And so that's why we're able to get our portfolio costs average between 0.2 and 0.3%, so 20 to 30 basis points. So we're on about a third of the industry average there, which is great. And so then let's talk about so we've already talked about the advisory fee. This is generally the inverse of tax bracket. So usually you would pay, let's just say 1 to 1.5% on the first $500,000, then it would go down to 1%. And then after $1 million, you're going to pay maybe 0.8, 0.9, and then 0.8, 0.7, 0.6. The more you have, the lower that percentage should go. The $10 million account doesn't have 10 times the amount of work a $1 million account. A $10 million account does have a lot more to plan for, potentially from estate planning. That person is probably, had an inheritance or created the wealth themselves through a business or was just a really good saver. So they probably have a lot more to do, but not 10 times the amount of work. And that's why a $1 million account may pay 1%, a $10 million account may pay 0.5%. Even though it's 10 times the size, they still get, in reality, they pay half of the percentage fee that they would otherwise.
I said tie a bow on all that. So like commissions, if you work with a firm like us, those don't exist. And then the expense ratio, you can never avoid those, whether you buy a fund through us or go online, that's going to the fund company. So that's with us as minimal as possible. And then the third is the advisory fee, which obviously is fee for us doing the work. So that's like, we feel is, that's minimized as much as possible. Some of the expense ratios could be higher on top of that advisory fee. And,
absolutely. Yeah. So Jamison, give us an idea. If someone is paying a percentage of assets, like there's industry data out there. So what should someone, on average, what do we see? Because supply and demand and capitalism really takes care of pricing. A lot of people think like, oh, pricing should go down. I think what's going to go down is like someone that's just managing investments is going to become totally irrelevant because that's not worth paying for. But someone that does all of the things I listed out, full comprehensive financial planning, actually does the follow through, those are far and few in between. And I think the pricing is actually going to go up because good luck finding a good firm that can actually do all of that for you, has your best interests, and does it consistently. So I do think the pricing will go up for those type of people that are doing the comprehensive approach. But as we stand today, I think this...
this is up until 2020. And I'm glad you said that because I was researching this, and actually a couple weeks ago, I came across a Vanguard article. And so we're going to go through data through 2020, but what this article said was because of COVID and like seeing rapid portfolio changes, there's been fee compression up until like 2020. And then after COVID, fees actually have increased because people want to pay for advice more because the understanding from that article was they've seen mistakes made and like people messed up and lost money during COVID and stuff. So to your point, I think fees are going up, but this is up until 2020, this is just the not including that soft cost is just like what the fee that would go to the advisor. This is like 10th through the 90th percentile. We'll just go through like $1 million, the 50th percentile is 1%, and up to 5 million, 50th percentile is 0.78%. And obviously above that would drop down below that. But I always tell people very candidly, you don't want the cheapest. The cheapest is like you're probably not getting any advice, and you don't want the most expensive most of the time. Or for an advisor, I would say somewhere in the middle is usually what fits the best.
Absolutely. Well, just to wrap up some our discussion here. So advice to the audience, just direct advice. If you work with a commission salesman, and this commission salesman really has your best interest in heart, not only like meet with him, do the advice, buy the term life, get the investment started, have him educate you about, if you get to a certain level, he could transition, refer that person. Because in general, that person, there's only so many good people like that out there. And there's such a wealth gap in America, but there's such a advice, there's such an availability gap of good financial planners. So usually commissionable salesman will talk to anybody. If you find a good one, make sure you sell it. If that person's calling you all the time, trying to sell you products all the time, that I would run away as much as possible. So just in general, probably 9 out of 10 of these people would recommend, not doing business. 1 out of 10, definitely not only do business with them, but refer them around to all your friends and family. If they have the same net worth as you, then this is a good person that's going to do a better job mostly than any technology could, and is going to handhold you through everything. So that's advice for the commissionable salesman. For the hybrid, the advice would be, because there's some of the best financial advisors are hybrids, just period. Because just for the mere fact is this is where most financial advisors are. Just
you're flexible. You can do either.
You can do either or. So the advice would be, does that person fully disclose the hats that they're capable of wearing? Does that person disclose the hat that they're wearing for you? Does that person provide the pros and cons to both? And is that person willing to grow with you? Do you have a one need that you're going in to solve, or do you want a long-term relationship? And then are they going to offer the fiduciary hat? And if so, that person's probably great. So same advice, do business with them. And again, they're probably operating off of word of mouth. So refer them to your friends and family. The fee only hourly person If you are one of two categories, so one, you think you want to do this all yourself but need education, the fee-only hourly person is probably a good option. Or two, if you've already done it yourself but you have a really complex situation, go see a fee-hourly person. If you're a person that doesn't want to do it yourself, wants to fully delegate it, I don't think a fee-hourly person is going to be good, because most of the actual implementation work, which is much harder, they can say, oh, it's easy. Doing a backdoor Roth every year, doing a mega backdoor Roth, calling the company, rolling the after-tax money out to the Roth, getting your estate plan done. If you're a business owner, getting a cash balance plan, getting your 401k census up to date. Doing that through a fee-only advisor, all the work's going to fall on you, and you're going to lose so much money with looking at what your time's worth. It's not even worth discussing. So a fee-only hourly advisor can be amazing if you're going to end up being a do-it-yourself, or if you already are and you need help with one or two problems. Where generally speaking, I'm saying for like physicians, executives, business owners, that they want to free up their time, they need to fully quarterback it. That's where the fourth option, in our opinion, would be best. That's the RIA model. So no fees to get in, no fees to get out. Look for a firm that doesn't do a contract. So if you don't think the fee is worth it, you can leave any time. And then make sure that they truly, even though legally they are required to have your best interests at heart all the time, look at how they provide advice. If you're doing private equity transactions, if you're doing real estate transactions, are they always guiding you away from that? Are they really taking a deep dive and educating you on how that may fit or may not fit? Inherently, when it is a conflict, when they'd prefer that you invest the money with them from a revenue perspective. But if they're really focused on your financial plan, they're always going to give you the advice and respect what you want to do with your money as your life by design. So hope that wraps up our podcast around how the financial planning industry works around fees. Hope this was helpful. And if you haven't already, please rate the podcast and please share with friends and family. The more we grow this thing, the more guests and the more content we'll be able to create for our audience. Thank you very much. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.